Be Wealthy and Smart, episode 535.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about the Tax Cuts and Jobs Act and ideas for tax breaks to use or lose. So basically, I'm going to share two articles from CNBC.com that are about tax breaks. One is about last-minute tax breaks for you to take advantage of, and the other is about tax breaks that have gone away in 2018 that you might not be aware of, and you need to know so that you're not counting on them for 2019. So I'm actually sharing two different articles from CNBC.com. The first is by Andrew Osterland, and it says, here are 5 last-minute tax moves you can still make before you file. And it has 3 bullet points. It says, most chances to cut your 2018 tax bill expired December 31, yet there are still 5 things you can do before April 15th. Second bullet point says you can reduce taxable income by contributing to an IRA or rolling capital gains into an investment opportunity zone, among other moves. And the third bullet point says to help reduce your 2019 taxes, review your withholding rate now. And the article says, most of the last-minute opportunities to reduce your tax liabilities for 2018 have come and gone. You can't deduct charitable contributions you make in 2019 from last year's income, nor can you deduct expenses against last year's income for medical procedures you get now. You can't give 2018 tax-free gifts to your heirs today or harvest losses on investments tomorrow to offset gains realized last year. The bulk of the things you could do to reduce your tax bill for last year expired on December 31st, but not all of them. There are still a number of steps taxpayers can take to help reduce the bite on April 15th. Some have been available to taxpayers for years, while others are a result of the Tax Cuts and Jobs Act passed last year. Here are 5 things to consider before filing your return this year. Number 1, individual retirement account contributions. Taxpayers can still make tax-deductible contributions to an IRA. Unlike 401k contributions that have to be made before year end, taxpayers have until April 15th to contribute to their IRAs and still deduct them from 2018 income. It's one easy thing you can still do now to reduce your taxable income for last year, said Amy Wang, a senior manager of tax policy and advocacy for the American Institute of CPAs. If you don't participate in a workplace retirement plan, you can deduct up to $5,500 in IRA contributions and can add in another $1,000 catch-up contribution if you're over age 50. If you are in a 401k plan at work, you can still deduct IRA contributions to the full $5,500 limit if your adjusted gross income is less than $63,000. The deduction phases out for taxpayers with income between $63,000 and $73,000 and disappears over that income level. Number 2, getting in the zones. One of the key job-creating incentives in the Tax Cuts and Jobs Act is the creation of more than 8,700 low-income opportunity zones across the country. Individuals or companies that invest in these zones through qualified funds can defer or avoid taxes on capital gains they've made elsewhere. For example, if you sell a $100,000 portfolio of stocks that has produced $50,000 in capital gains, you would owe as much as $10,000 in taxes on the gain depending on your level of income. However, if investors roll the gain into a qualified opportunity fund, they can defer the taxes due until 2026 or until they sell the new investment. They can also reduce the taxable gain if they hold the investment for at least 5 years. The longer the holding period, the greater the reduction of the gain subject to tax. As long as people make the new investment within 6 months of selling the other assets, there's no limit on how much they can invest, says Roger Spielman, a tax partner at New York-based accounting firm Markham. They can do that now. Most of the investments in the qualified opportunity funds are in real estate projects and local businesses within the opportunity zone. Rules apply. Individuals or entities looking to take advantage of the incentive should consult a business expert or accountant on their options. Number 3, changes in accounting method. For self-employed taxpayers and small business owners, changing the method of accounting for your business from an accrual to a cash basis or vice versa can save on taxes. Any business with gross receipts of less than $25 million can change its accounting method this year, said Spielman. Switching from an accrual basis, which is recognizing income when it's earned, to a cash basis, which is recognizing it when you actually get paid, will reduce taxable income in 2018. Taxpayers can make the change in either direction regardless of the accounting method they used in the prior year. Depending on the timing of income you earned and when you received it, the difference and the taxes thereon can be substantial. Number 4, the qualified business deduction. One of the key benefits to small businesses in the Tax Cuts and Jobs Act is the new 20% qualified business deduction. If a sole proprietor or business owner earns less than $315,000 of income, they can take a full 20% deduction on income before itemizing their other deductions. The size of the deduction decreases on income over that amount and goes to zero on income over $415,000. While small business owners can't make any investments now that would alter the size of the 2018 deduction they can take steps to lower their income to get under the $315,000 threshold. Chief among them is taking advantage of more flexible rules on depreciation expenses in the Tax Cuts and Jobs Act. Businesses can now depreciate the full cost of qualified property in the year they purchased it. They can also increase the so-called Section 179 depreciation expenses they claim up to $1 million for 2018. It may not always make sense to accelerate depreciation expense. Some professional advice on these complicated rules is probably a good idea. The rules related to businesses are complex, but there are significant tax savings opportunities, says Spielman. For our clients, we generally look over a 2 to 3 year period to maximize benefits. Number 5, revisit your withholding taxes. It won't change your tax situation for last year, but planning for this year sooner rather than later always makes sense for taxpayers. This is a good time to plan for next year too, said Wang. Item number 1 on the to-do list for many taxpayers is probably an adjustment to their W-4 tax withholding schedules with their employer. Tax refunds are way down this year, and many people are very unpleasantly surprised to find they owe the government more taxes. People generally saw their paychecks increase last year due to the cuts in marginal tax rates, but in many cases, changes to the withholding schedules left taxpayers owing more money at the end of the year. To avoid another unpleasant experience next year, act now. If you're getting a large refund this year or owe a lot of taxes, you need to adjust your withholding with your employer now, said Wang. End of article. And I will post this in the show notes and on my website so you can take a look at it. And now we'll go to the second article. So this article is about the tax breaks that are going away in 2018 so that you can be aware of them and not count on them for 2019 and make any adjustments that are necessary. This article was written by Darla Mercado, and there are 3 bullet points. Number 1, under the Tax Cuts and Jobs Act, the standard deduction increased to $12,000 for singles and $24,000 for married filing jointly in 2018. Second bullet point, 9 out of 10 filers are expected to take the standard deduction for 2018. Third bullet point, a number of itemized tax breaks are now limited, including a new $10,000 cap on state and local tax deductions. Others are gone. And the article says, if you were planning on taking a tax break for those unreimbursed expenses at work or the fees you pay your tax preparer, prepare to be disappointed. That's because the Tax Cuts and Jobs Act, the new tax legislation that went into effect last year, curbed itemized deductions. The new tax law eliminated personal exemptions, which were once valued at $4,050 for the taxpayer, spouse, and each dependent, and boosted the standard deduction to $12,000 for singles and $24,000 for married joint filers. As a result, few taxpayers are expected to itemize deductions. Nearly 90% of filers will wind up taking the standard deduction instead, according to the Joint Committee on Taxation. That means about 30 million fewer households will itemize deductions in 2018 compared to 2017. A surprise could be in store for some of those filers. People who itemize deductions and have no kids are likely to be negatively surprised, as well as those who work for employers who don't reimburse for out-of-pocket expenses like home offices and mileage, said Nathan Rigney, lead tax research analyst at the Tax Institute at H&R Block. Here are 6 itemized deductions that are out of reach or gone altogether from your 2018 tax return. The first is home office costs and more. If you hoard receipts, you're probably familiar with the grab bag of tax breaks known as the miscellaneous itemized deductions. Back in 2017, before the tax overhaul, you were able to deduct unreimbursed employee costs, tax preparation fees, investment expenses, and more, as long as they exceeded 2% of your adjusted gross income, or AGI. Telecommuters who work from home full-time will feel the pinch in particular. As employees, they were once able to write off a slice of their mortgage, utilities, and more for a home office. Under the new tax code, these breaks are out of the picture as of 2018. Number 2, theft and property damage. Under the old tax code, you were able to claim an itemized deduction for property losses that aren't reimbursed by insurance and that occur unexpectedly. This would include damage from fire, accidents, theft, and vandalism, as well as natural disasters. You were able to deduct the losses to the extent they exceeded 10% of your adjusted gross income. Now you can only claim personal casualty losses if the damage is attributable to a disaster declared by the President. This change is in effect through the end of 2025. The 10% threshold of AGI still applies. In 2016, 154,274 tax returns claimed a casualty or theft loss of deduction, according to the IRS. Number 3, state and local taxes. If you reside in New York, New Jersey, or California, odds are you're feeling the squeeze from property tax, real estate taxes, and state and local income levies. Meanwhile, 45 states and the District of Columbia levy statewide sales taxes, and municipalities in 38 states add on a layer of local sales taxes too, according to the Tax Foundation. Before the tax overhaul, you were able to nab an itemized deduction, known as the State and Local Tax Deduction, or SALT, for these levies. SALT, State and Local Tax Deduction. Kiss those breaks goodbye, at least to a certain extent. The new tax code places a $10,000 cap on state and local tax deductions, SALT deductions, which could dent returns for people living in high tax areas. In 2015, the average state and local tax deduction for New Yorkers who claimed the tax break was more than $22,000, according to the Tax Policy Center. Number 4, home mortgage interest. Prior to the Tax Cuts and Jobs Act, you were able to write off the interest for up to $1 million in mortgage debt. If you took out a home equity loan or line of credit, you were also able to deduct the interest paid on loans of up to $100,000. Now you can only claim a deduction for interest on up to $750,000 in qualified residence loans. That is, the combined amount of loans you use to buy, build, or substantially improve your dwelling and second home. The IRS has also applied new restrictions to interest claimed for home equity loans and lines of credit. You could only take the break if you were using the money to build or improve your home. The deduction is off the table if you took a HELOC to use for personal expenses. So I just want to pause and underline that if you're using your home equity line of credit or a home equity loan for personal items or something other than fixing up your home, it will not be tax deductible anymore. You must use your home equity lines of credit or HELOCs on fixing up your home. Number 5, charitable giving. The IRS continues to reward taxpayers with philanthropic inclinations as long as they give generously. The charitable donation deduction is still on the table even after the tax overhaul. The only difference now is how many people will be able to claim it. A combination of higher standard deductions and limitations on itemized deductions means that fewer people will be itemizing on their 2018 returns. In turn, that could put the charitable deduction out of reach for those taxpayers. If you fall just short of the new standard deduction of $12,000 as a single person or $24,000 as a married person and filing jointly, you might be able to itemize in 2018 if you bunch multiple years of charitable donations and get over the hurdle. Number 6, medical and dental costs. The tax overhaul temporarily lowered the threshold for the medical expense deduction. For the 2017 and 2018 tax years, you're able to claim an itemized deduction for out-of-pocket health care costs to the extent they exceed 7.5% of your adjusted gross income. Here's the bad news for people with steep medical costs this year. Starting in 2019, that threshold will leap back up to 10%, where it had been previously for most taxpayers. Bear in mind that while the IRS has lowered the bar for the amount of medical expenses you must incur in 2018, fewer people all around are likely to itemize their deductions due to the higher standard deduction. As a result, this break may no longer be available to you. End of article. All right, so there you have it. There are things that you need to adjust in your behavior this year because you don't want to get to the end of 2019 and then do an oopsie. These things are no longer tax deductible for me, such as what you use your home equity line of credit for. So if you're using your home equity line of credit to go on a nice vacation or buy a new TV or a new car, that isn't going to work for the deduction anymore. You have to be using it on your home or your second home. So make sure that you paid attention to what I said in this article and you put those things into practice because there are some major changes. It sounds like a lot fewer people are going to be itemizing because of these larger standard deductions that were given. So that means a lot of deductions that maybe you're used to, those aren't going to work for you anymore. So make sure to be aware of those and kind of wrap your head around that now so you don't have a nasty surprise at the end of this year. I will also post this article in the show notes and on my website so you can take a look and review it, maybe print it out and keep it close or talk to your spouse about it so your spouse is also up to date on what's going on with the tax laws and they can make the appropriate changes as well. If you haven't yet subscribed to Be Wealthy and Smart, please hit the subscribe button and you'll be updated as soon as new podcasts are available. Don't forget, we still have our review contest going on where 25 prizes are up to be won. 11 of the Wealthy Mindset Blueprint audios valued at $197, 11 Wealth Heiress books personalized for you, and 3 wealth mentoring sessions with me valued at $500. All you need to do is leave a review on iTunes. You'll get your name in the drawing 5 times. Leave a review on Amazon about the book, and your name will be in the drawing 7 times, or do both and your name is in the drawing 10 times. I'll be announcing the winners after March 30th. And we have a quick survey for you to fill out, 10 quick questions. Let me know what you like and what your suggestions are for the podcast so I can tailor make it just for you. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.